In today's market update, we're going to be discussing the 20-week cycle trough yet again, because we have been discussing this particular cycle trough for many weeks. And the reason for that is because it has been difficult to identify the position of the cycle trough. Now, when it is difficult to identify the position of a cycle trough, it's important to understand the reasons why and what the implications of that are. So here is an analysis of the S&P 500. This is using SPX data. And all of the analyses that we're going to be looking at today have this 18-month cycle trough on the 7th of April in common. That is, in my opinion, a good phasing for the 18-month cycle. Here is the trough that we have some questions about, the 20-week cycle trough. Here you can see in this analysis, this 20-week cycle trough has been positioned over here in the middle of August at that slight dip in the price action over there. Other possible positions for that 20-week cycle trough are, of course, over here at the beginning of August and also over here at the beginning of September. So we have three possible positions for this 20-week cycle trough. How is that possible? I know that many of you would like to achieve certainty in your analysis. The truth is that it is rarely possible to achieve absolute certainty in an analysis. The analysis process was described by Hurst as being as much an art as it is a science. And that is because of the nature of the analysis that we're performing. Cycles are constantly influencing these markets, and the effects of those cycles is only apparent after the fact. The important thing as traders of these markets is to be able to take an analysis around which there is still some uncertainty and convert that into making confident trading decisions. We will never know with 100% certainty whether we are making the correct decision because of the inevitable analysis uncertainty. The important thing is to move from analysis uncertainty into making reliable and well-informed trading decisions. But that's not the subject of this video. In this video, we are purely discussing the analysis. And I should warn you, this is going to be a bit of a geek video. We're going to be focusing on some of the details. And so if focusing on detailed analysis is not your thing, then you might want to skip over to another video. So let's discuss the problem with this 20-week cycle trough. Why can't we see it in the markets? Why has price not come down nicely into a good 20-week cycle trough? The reason is because this 20-week cycle trough is being overshadowed by longer cycle influences. We have longer cycles that are pushing upwards. When longer cycles are pushing upwards, the shorter cycles are unable to bring the market down to form clearly visible troughs in the price action. It is not an indication of a failure of the cycles. It is a simple fact of life. The longer cycles are pushing the markets upwards. The interesting thing that is happening at the moment in these markets is that the US markets have continued to push upwards. However, other markets around the world have failed to continue upwards. Yes, the Australian market, I'm looking at you. Also, Bitcoin, which was only a few weeks ago the poster child of Hurst cycles, is failing to push upwards from its 20-week cycle trough. There's a very important message in that, and that's why this video is particularly important in terms of understanding what is happening. So let's first focus on the US markets, which are continuing to move upwards. What is happening here? Well, in Sentient Trader, we can display what are called cycle lines. These are the lines that demonstrate the influence of each one of the individual cycles. Here we can see four different cycles, the 40-day all the way up to the 40-week cycles displayed. But let me separate them out and display only the 80-day and the 40-day cycles. Let me show you something that has been happening to the 40-day and 80-day cycles. Now, of course, the height of this sine curve represents the amplitude or the force of that cycle. So you can see that back in April, both the 80-day and the 40-day cycles had a fairly high amplitude. Notice what has been happening to both of these cycles. Their amplitude has been diminishing. You can see these converging lines across their amplitude. And so the shorter cycles have been losing their strength. Of course, this might not be a matter of the shorter cycles losing their strength so much as the longer cycles simply overpowering them and taking their strength away from them. because the strength of these particular cycles is not currently visible in this market. Now, while we're looking at the 40-day and 80-day cycles, let me point out something else that's very important to understand about the way in which these cycles combine. From this 80-day cycle trough over here in the middle of June to this 80-day cycle trough, according to this analysis in the middle of August, you can see that the 80-day cycle pushed upwards, formed a peak, and then pushed downwards. Now look at the 40-day cycle. The 40-day cycle pushed upwards, formed a peak, came down into, of course, the 40-day cycle trough, then pushed back up again, and then down again. The result of combining these two cycle influences is our M-shaped action that we expect to see in the markets. But now take a look at what actually happened in the price action. Where is that 40-day cycle trough? Let me clear these pen marks so that it is a little clearer. Where is that 40-day cycle trough? You can see it was hardly possible to identify a trough of 40-day cycle magnitude in that price action. That is a clear illustration of the fact that the 40-day cycle influence was overpowered by longer cycles. In this case, the 80-day cycle itself, of course, was overpowering it, but also longer cycles as well. And so the result of the way in which these cycles combine is that you sometimes get what we call a subtle or a straddled trough in the middle of the M shape. And so we know that this happens. It is a result of the mathematical way in which these cycles combine. And so that is probably what is happening with this 20-week cycle at the moment. Because of the overpowering effect of the longer cycles, it has been very difficult to identify its position in this market. Let's display the cycle lines for the 20-week and the 40-week cycles again to understand what is happening. First of all, the amplitude of the 20-week cycle still looks fairly healthy, doesn't it? It has a good upwards move and then a good downwards move. Why is our calculation of the amplitude not showing a diminished effect of the 20-week cycle? The reason for that is that, of course, it doesn't yet have enough information to calculate that diminished amplitude. Why is this market moving upwards so strongly? The answer to that question is possibly in the 40-week cycle line, indicating that the 40-week cycle has been pushing up for all of this time. You can see that in the cycle line, it indicates that this 40-week cycle should now be turning down. It should be providing some downward pressure. Why have we not seen any downward pressure? Again, the answer lies in the longer cycles. What is the cycle longer than the 40-week cycle? It is, of course, the 18-month cycle. And if we display the cycle line for the 18-month cycle, all of our other cycles have been a little squashed because of the magnitude of that cycle. So let me expand them a little. And now we can see the strong upward pressure that has been applied by the 18-month cycle and, of course, also the 40-week cycle. Why is this market continuing to rise? The answer probably lies in the fact that the 18-month cycle is still pushing upwards. The important thing to note, however, is that the 40-week cycle has started turning down, and it is possible that that 40-week cycle has had a greater influence on the European, Australian markets that we're going to be looking at in a moment, and also Bitcoin. Why has this turning down 40-week cycle not yet influenced the US markets in the same way that it has influenced the other markets? Of course, the cycles will have a different amplitude in all of the markets. However, the big danger sign that is beginning to flash in these markets is that the 40-week cycle, which has turned down in the European, Australian markets and also Bitcoin, is going to do the same thing in the US markets. And that the US markets are continuing upwards more on the basis of, perhaps one might call it, hope, rather than pure cyclic influences. If we connect those tops and connect these troughs, we have a rather worrying converging wedge, which in Elliott wave theory is an ending pattern. I'm not saying that the market is turning down yet, but I am saying that we need to stay on our toes. It is quite possible that the 40-week cycle in the US markets has lost some of its strength, and it's riding now on the 18-month cycle. Certainly, if you're a bullish investor in the US markets, that is what you are hoping is happening right now. But there is a bit of a warning sign flashing from across the oceans that we need to pay attention to. So let's see if we can consider the difference between the three possible positions for this 20-week cycle and come up with a decision as to where exactly that cycle trough lies. This analysis, as I've already mentioned, positions the 20-week cycle trough in the middle of August. There it is over there. I've left the pin symbols visible on this analysis so that you can see I haven't actually influenced this analysis. This is Sentient Trader's opinion as to the best position for this 20-week cycle trough. If we count the number of days that elapsed up to that point, you will see there were 135 days. One of the reasons why Sentient Trader likes that position for the trough so much is that the average length of the 20-week cycle discovered by Hurst 50 years ago was 136 days. And so this trough came in 1 day early. But of course, we do not perform a cycle phasing analysis purely on the basis of only measuring the wavelengths of this particular cycle. A much more important aspect of the phasing analysis process is to be able to identify the troughs of the shorter cycles. Performing a cycle phasing analysis is a wonderfully complex puzzle-solving process, and it is sadly a rather arcane practice. The process of performing this cycle phasing analysis is a process that seems to be dying out, and I must say I feel fairly responsible for that, having produced software that performs the analysis for you. I do constantly say to users of my software that it's important to learn to do this for yourself, because as good as software might be, the best cycle phasing analysis is always going to be performed by people, and it's very important, in my opinion, to be able to perform an analysis yourself manually rather than simply to get software to do it for you. And so an important part of this analysis process is being able to identify the shorter cycle positions. So when trying to find the 20-week cycle trough, we don't simply measure the distance to the 20-week cycle trough. We need to find evidence of two clear 80-day cycles that have played out within that 20-week cycle. And in order to do that, we take a look at the position of the 80-day cycle trough. Notice in this analysis that 80-day cycle trough has been positioned over here. Now, that's a slightly questionable position for that 80-day cycle trough. This position might be slightly better, although if you go back to the videos I was recording in June, you will see that there was a little bit of fundamental interaction over here that potentially caused a slightly lower cycle trough on this day. And so I'm willing to accept that that is a fairly good position for the 80-day cycle. Now, the other thing that we expect is for these cycles to have a fairly regular rhythm. And so if we measure the number of days up to that 80-day cycle, you can see it was 67 days. The average length of an 80-day cycle is 68 days. If you don't understand why that is, I would encourage you to download the 10 core concepts document that I will provide a link to in the description below this video. And so we had 67 days that elapsed from April until June. We would then expect the next trough of that cycle to occur 67 days later. And indeed, this trough over here in the middle of August occurred 68 days later. That has a nice, good rhythm about it, and so this is by no means an impossible position for the 20-week cycle trough. However, we would expect the 20-week cycles of various stock markets around the world to occur at the same time because of the principle of commonality. And so let's start looking at some other markets. First of all, we're going to stick with the US markets. Here is the Nasdaq, and the Nasdaq too has an 18-month cycle trough over here on the 7th of April. Here is our 20-week cycle confidently placed over here in the middle of August. Again, we have the slightly unusual position for the 80-day cycle. And so this analysis matches exactly the analysis that we have in the S&P 500 at the moment. So what is the problem? Why am I questioning that middle of August cycle trough? Let's take a look at the Australian market. Now, in the Australian market, we have also a very important cycle trough over here at the beginning of April. I've discussed this in previous market update videos. Here is the trough we are discussing today, the 20-week cycle trough, which you can see has been positioned under this cycle trough over here. If you look at that date, you'll see it's in the first couple of days of September. And the 20-week cycle trough that we were looking at in the US markets was over here in the middle of August. Now, is it possible that the Australian market experiences a 20-week cycle about 2 weeks after the US market? Yes, it is. The principle of commonality does not tell us that 20-week cycles have to occur on exactly the same day in various markets around the world. Hurst's exact phrasing was that they have a good deal in common. and so just a couple of weeks apart is not too much of a big divergence. It's also fairly easy to understand why this 20-week cycle trough has been positioned over here on the 3rd of September, because again we need to look at the shorter cycles. If we measure the distance or the wavelength of this 80-day cycle from April until the 3rd week of June, you can see that is 77 days. We would expect that cycle to repeat with roughly the same rhythm, and so our first expectation is that 77 days later we would see another cycle trough forming. 77 days is over here on the 8th of September, and so just 5 days earlier this 20-week cycle trough has been identified. And so this analysis works fairly well for the Australian market. We could of course position the 20-week cycle trough over here at the beginning of August. But then when it comes to breaking down the shorter cycles, if we measure that distance to that trough over there, that's 118 days. Not impossible, it would be a short 20-week cycle, but by no means impossible. We would expect to see some evidence of a cycle trough about halfway through that cycle at about 59 days, which would mean we'd be looking for a cycle trough somewhere about here. You can see there is absolutely no evidence of a cycle trough forming here. The clear evidence of the cycle trough occurs only here at 77 days, leading us to expect that these cycles have been stretching recently, and therefore this is the better position in the beginning of September. So what's the problem? We've identified a 20-week cycle 2 weeks earlier in the US markets than occurred in the Australian market. Here is the problem. What has been happening since this 20-week cycle trough formed in the Australian market? We got a good bounce for 2 days. Then, of course, price sort of subsided again. Price came back up to the 20-day cycle FLD, and we were expecting, of course, our A category interaction, which is what should happen after a 20-week cycle trough. And you can see what happened. Price slipped over the FLD over a weekend, not unusual, and it experienced a down day on this Monday over here. It tried getting up again on Tuesday, but it failed significantly and it dropped down again. It is trying again to get above the 20-day cycle FLD. What does this mean? Is this simply a slow cycle to pick up? Well, it could be, but it is a bit of a warning sign, because something is holding this market down. As opposed to the US markets, which are continuing to stream upwards, this market is struggling. And the obvious answer to the reason why it is struggling can be determined by taking a look at our cycle lines. Our 20-week cycle should be pushing upwards. Our 80-day cycle and 40-day cycle, despite their diminished amplitude, are also pushing upwards. So what is pushing downwards? Well, the answer lies, of course, in this 40-week cycle. This is a critical moment for the Australian market and possibly for markets around the world, because if the Australian market does manage to kick off and break up above that 20-day FLD, we'll forgive it and we'll say, okay, you had a bad 20 days. But if it fails to kick off at this point, we need to accept the fact that the 40-week cycle is pushing downwards with some strength, and therefore the market is probably generally headed downwards into the next 40-week cycle. Taking a look at another market, the German DAX. Now, the DAX also had potential positions for the 20-week cycle trough forming. There was this potential position over here, which I discussed in a previous market update video. I dismissed it because of this very clear trough that formed over here. That is clearly a trough of a fairly important cycle, and if we measure the number of days, you will see that there were 73 days that elapsed. The average length of an 80-day cycle is 68 days, and so that is clearly an 80-day cycle trough. We would expect the next 80-day cycle trough in about 73 days from that time, and so we measure forward 73 days. And here we find again at the end of August, 73 days exactly is the 31st of August, and indeed we did have a trough that formed in the DAX on the 2nd of September. It's this little trough over here. I call it a little trough because there hasn't really been much of a bounce out of that cycle trough. Notice that the analysis we have at the foot of the chart still shows a nest of lows. That's because Sentient Trader is a little reluctant to call this the 20-week cycle trough or this the 20-week cycle trough, because it simply doesn't make sense with the breakdown of the shorter cycles. Is it possible that this 20-week cycle trough has formed over here? It is possible. It stretches that cycle fairly long, out to 162 days. That is not impossibly long. So yes, it is possible that the 20-week cycle is forming even later in the German market than it did in the Australian market, and several weeks later than it did in the US markets. Again, we need to see what is going to happen here, because if price manages to break out of the cycle trough, we will assume that the DAX simply experienced a late 20-week cycle trough. However, if it fails, we need to accept the fact that the 40-week cycle, which must by now have turned down, is influencing price, and therefore we are looking at a generally downward price movement into the next 40-week cycle trough. Then we have Bitcoin. Now, Bitcoin was really doing wonderfully in Hurst cycles terms. It has recently disappointed a little, but possibly not because it is breaking the Hurst cycles rules, possibly simply because the 40-week cycle has turned down rather hard in Bitcoin. And so there could be a good lesson to learn from this Bitcoin analysis. We have an important cycle trough, in this case a 40-week cycle trough, that formed also at the beginning of April. Here is our very clear 80-day cycle trough. You can see the good, clean cycle shapes that played out for that 80-day cycle. If we measure the number of bars, or the wavelength of that 80-day cycle, you will see there were 74 days that played out. 74 days is not bad for an 80-day cycle, average length of which is 68 days. If we measure forward another 74 days from that point, you will see that brings us to the 4th of September. And indeed, an appropriate cycle trough did form on the 1st of September in Bitcoin. And so here is that 20-week cycle trough in Bitcoin. I think there can be little question about the fact that the 20-week cycle trough formed in Bitcoin on the 1st of September. Now, by the principle of commonality, that might mean that the 20-week cycle trough also formed in all the other markets that we have looked at. But of course, we do not require those 20-week cycle troughs to have formed on exactly the same day in all of the markets. But we have some very clean M shapes that have been playing out in Bitcoin. And I think you can see why I described Bitcoin as the poster child of Hurst cycles in our previous market update video. Things were going very well. Now, things are possibly still going very well for Bitcoin, but we need to zoom in and take a look at exactly what has happened, because what has happened is that Bitcoin has started to disappoint on the bullish front. What do I mean by it has started to disappoint? Well, here you can see there have been 22 days that have elapsed since the 20-week cycle trough on the 1st of September. Here is our nest of lows for the 20-day cycle trough. In a video that I published last week, I identified a potential trading opportunity that was approaching for Bitcoin. It was, of course, approaching for many of these markets, in fact, for all of them. And the same trading opportunity proved fantastically profitable so far in the US markets. In Bitcoin, however, the trading opportunity simply did not manifest. What was the trading opportunity? You can go back and take a look at that video. What should happen as the 20-day cycle trough forms following a trough of 20-week magnitude is that the 20-day cycle FLD provides support for price. Has the 20-day cycle FLD provided support? Absolutely not. In that video, I described 3 potential entry methods. One of those methods was to set a limit entry at the level of the 20-day FLD. I warned that was a very aggressive approach and not probably the best one. And indeed, if you had set a limit entry and ignored all the warnings about it being not the recommended approach, then you would have been very disappointed to see price falling down. The recommended approach is to wait for evidence that support has been found at the level of the 20-day FLD. Absolutely no support formed at that level. And so therefore the trading opportunity simply did not manifest. Now, it is possible that Bitcoin is now forming a late 20-day cycle trough. Why do I say late? Because the average length of a 20-day cycle is 17.1 days. And so it would at this point be about 5 days late. You can also see that recently this 20-day cycle has been beating with a length of 17.5 days. And so it is possible that the 20-day cycle trough is forming down here at this level, and we're now going to see a bounce out of the 20-day cycle trough. Perhaps that will happen synchronously with a bounce out in the Australian market and also the German market. And we're going to say, okay, the markets, some of the markets had a bad 20 days, and we're back on track and the markets are bullish. But what is much more worrying is the possibility that the 20-day cycle trough did in fact form at about 17 days. If we measure 17 days, you can see that's somewhere over here in about the middle of last week. Is it possible that this is in fact our 20-day cycle trough right over here? That is, of course, a straddled trough. What does that mean? Well, it means the 40-day cycle is now turned down and bringing price down into the 40-day cycle trough, which we're expecting over here in about the first week of October. But what is more worrying is that price has dropped down below this 20-day FLD. That's not the kind of behavior that we expect from you, Bitcoin. And so what is possibly happening in Bitcoin and also in the Australian market and the German market? What is possibly happening is purely natural, and it is what we do expect to happen. That is that the 40-week cycle has turned down and it is causing this market to now move downwards. Notice that the next 40-week cycle trough in Bitcoin is also synchronous with an 18-month cycle trough, and so it is likely that we have downward pressure from both the 18-month cycle and also the 40-week cycle. And so I am no longer feeling very bullish in Bitcoin. It would need to prove that the 40-week cycle is still supporting an upward move before we would consider another long trading opportunity in Bitcoin. We might start considering some short trading opportunities, but only when the current position of the 20-day cycle has clarified. Finally, I would like to take a very quick look at the Nifty, which is another interesting stock market that has provided us with some interesting commonality. Notice here we have an 80-day cycle trough that formed in the second week of June. If we measure these cycles and perform a bit of manual confirmation, you will see that cycle came in at 67 days. This positions the 20-week cycle over here on the 29th of August. So the Nifty analysis is not really the same as the US analysis anymore. It is supporting the analysis in the German market, the Australian market, and also in Bitcoin, with a 20-week cycle trough occurring in the last few days of August or the first few days of September. And so this analysis looks good to me. The Nifty has done better than the Australian market or the European market. It has crossed up nicely above its 20-day cycle FLD. But seeing as 26 days have elapsed since that 20-week cycle trough formed, a 20-day cycle almost certainly has already formed in the Nifty. This is probably it over here. The Nifty can be a little difficult to analyze because of reduced trading hours and other complications, but it seems that the 20-day cycle trough has already formed, which means that now the Nifty is expected to cross down below the 20-day FLD. Notice this lower peak over here, and we potentially have a bearish M shape beginning to unfold. Of course, it's too early to say. The Nifty might reach up and form a higher peak, but certainly we need to stay on our toes, or traders of the Nifty need to stay on their toes because of the danger that the 40-week cycle has turned down and is now causing this market to move downwards into the next 40-week cycle trough. I do hope you found this market update useful and interesting. I know many of you are going to say, where is gold? I have a lot to say about gold, but this video is already long and I thought that I would focus on the 20-week cycle trough. So look out for a special update coming soon about gold and what gold is doing, which is of course reaching up to a new high, that sharp isolated peak that I've been expecting in gold for several weeks, but that will be the subject of a separate video. If you have any questions, please put them in the comments below this video or join us on our Hurst Cycles Discord server. I look forward to hearing from you.